All right, let's dig into a really interesting one from this earnings season. We're talking about International General Insurance Holdings, ticker IGIC. Now, on paper, this quarter looked like a total miss. But the stock, yeah, it told a completely different story. Let's break down what actually happened.
So here's the central mystery, right? You've got an earnings miss, a revenue miss. I mean, that's usually the kind of 1-2 punch that sends a stock tumbling. But not IGIC. It actually surged over 5%. The question is, why? What did the smart money on Wall Street see that the headlines completely glossed over? That's exactly the puzzle we're going to piece together today.
Okay, so first, let's get on the same page and look at the numbers that caused all that initial confusion. This is what you would have seen if you were just skimming the newsfeed, what the algorithms would have reacted to in the first few seconds of trading.
And yeah, here they are. It doesn't look great at first glance. Adjusted earnings per share, a miss. Revenue, it came in about 5% short of what everyone was expecting. And then you look at gross premiums written, which is basically just the total amount of business they wrote, and that was actually down about 5% from this time last year. So by any normal metric, you'd look at this and think, yikes, that's a weak quarter.
But as you've probably guessed, that is not the real story here. The market, it seems, looked straight through that top-line weakness and found something much, much more important. An absolute masterclass in how to run a profitable insurance business. And this, my friends, is where it gets good.
Now, to really get this, we have to talk about one of the most important numbers in the entire insurance industry, the combined ratio. For anyone who isn't living and breathing insurance stocks, think of it as the ultimate profitability score. It's just the total claims and expenses divided by the premiums you brought in. If that number is under 100%, you're making money from your core business. The lower it is, the better you're doing. Simple as that.
So, what was IGCIC's combined ratio? A jaw-dropping 76.5%. I mean, seriously, let that number sink in for a second. That is not just good, it is absolutely elite. It means for every single dollar they took in as a premium, they only had to pay out about 76.5 cents for claims in running the business. That's what a profit-making machine looks like.
And where does all that incredible profit go? Well, it flows straight to the bottom line. The company posted a core operating return on equity of almost 23%. Just for some perspective, finding a specialty insurer that can consistently hit returns like that is, well, it's incredibly rare. This is the exact kind of number that makes institutional investors stop what they're doing and pay very, very close attention.
So you see what's happening here? The big takeaway is that even while the amount of business shrank a little, the quality of that business was off the charts. The company's core profit engine was just firing on all cylinders. We're talking over $51 million in pure underwriting income. They grew their book value per share by more than 9% in just 3 quarters. And get this, they even found an extra $10.5 million in profit because they'd been too conservative with their old claim estimates. I mean, this is a picture of a company in ridiculously good health.
So the big question is, how did they pull this off? Was it just luck? No way. This was all part of a very deliberate, very disciplined playbook from the management team. Let's take a look at what they actually did.
This one quote from their earnings call really says it all. "We will not sacrifice the bottom line for the benefit of the top line." It's so simple but so powerful. They basically looked at a market that was getting a little too competitive, and they drew a line in the sand. They decided they were absolutely not going to chase unprofitable growth just to make the revenue numbers look pretty. And they weren't just talking, they were acting. Step 1, they walked away from a big piece of business, a professional indemnify account worth around $50 million because the margins just weren't good enough. That's why their premium growth was negative. It was on purpose. Step 2, they bolstered their credibility in a huge way by getting a ratings upgrade from S&P to A. That's a massive deal. And step 3, they put their money where their mouth is, announcing a new $5 million share buyback. That's management screaming, "We think our stock is cheap." Okay, so you've got this fascinating picture, a messy headline miss, but underneath, a story of incredible strength, discipline, and smart moves. So how did the market, in all its collective wisdom, put it all together? Well, the verdict was clear. Quality gets rewarded. Plain and simple. The stock gapped up at the open and just kept on grinding higher all day long. Why? Because as more and more analysts and investors actually read the report and listened to the call, they understood the real story. And it ended the day up a super strong 5.5% on a day when the headlines suggested it should have been deep in the red. And here's the kicker. This wasn't just some sleepy, low-volume drift higher. No.
This move had some serious firepower behind it. Trading volume was almost 3 times the daily average. That tells you that big institutional money was stepping in and buying with conviction. They were validating management's entire strategy of profitability over growth.
All right, so that brings us up to speed on a fantastic Q3. But what about the future? That brings us to the next call, where we look at everything we just learned and try to figure out what to expect from IGGC in Q4 and into next year.
So here's the debate as we see it. On the one hand, you have the bull case. The bulls are saying that new A rating is a total game changer. It's going to open doors to premium business they couldn't even bid on before. Meanwhile, their discipline keeps those returns sky high, and the buyback keeps adding value for shareholders. But then there's the bear case. The bears are worried that intense competition is going to keep pressuring growth, and that the full impact of walking away from that $50 million account is going to smack the top line hard in Q4. Plus, they had a little currency tailwind that might just turn into a headwind.
So where do we land in this debate? Well, for us, it comes down to quality. Our rating on IGIC is outperform. We're betting that the market is going to keep rewarding this company for its best-in-class profitability and its incredibly smart capital management. That S&P upgrade is a major catalyst, and honestly, we think the street is still underestimating its impact.
And that leads right into our trade idea. Here's the pitch. The thesis is that the A rating changes everything. So the trade is simple. You own the stock. Why? Because you believe the market is going to stop valuing IGIC like an average, boring insurance company based on its book value and start valuing it like the elite, high-return business it actually is. That's a re-rating based on its premium return on equity. The catalyst you're watching for? It's simple. You listen to the next 2 earnings calls for any mention, any evidence at all of new business wins that they got because of that S&P upgrade. Once you hear that, you know the re-rating is officially underway.
Okay, before we sign off, as always, we have to go through our very important disclaimer.
And just a final critical reminder. Nothing in this analysis is financial advice. It's all just for informational and educational purposes. You've got to do your own homework and talk to a professional before making any investment decisions. Thanks so much for tuning in.